Hello, welcome to It's Your Smarter Money with Atlas Fiduciary Financial. Today, we want to talk about tax loss harvesting, something that we've been actively doing for really all of 2022, right, Steve?
We've been doing a lot in the last couple of months, in fact. Uh, and we'll see, and you'll see as we discuss this further in this video that it's helpful. It's not always as beneficial as people may think it is, but it's certainly helpful.
Right. So if you want to click to the next slide, just want to start out by talking about the fact that when you invest, it's inevitable that you're going to have stocks that go up and stocks that go down. And the way we deal with this stochastic movement of returns and different asset classes moving in different patterns is we have a lot of different strategies. So we've talked to you about the idea of diversification, and we've talked to you about the idea of rebalancing. And there are a variety of other things we're doing as well. But today we want to talk about tax loss harvesting, because in essence, what we're doing is we're taking advantage of the opportunity to create an asset out of an asset that has gone down or a specific investment that's gone down. So really what we're looking at is, last year when everybody was riding the markets as they were going up and most of our asset classes were doing quite well, we saw a lot of gains. We also saw people came to us with a lot of gains that they had over time. And we created strategies on how to unravel those gains. Some people were in very risky portfolios that they had developed very risky assets over time. And they were
also
afraid.
they may have had holdings that we didn't think were the best holdings. Perhaps the internal expenses in the mutual fund or the investment they brought to us were high. We didn't think perhaps the prospects for that fund were very good because it was an actively managed fund and the active managers weren't that great. But we would hold off capturing those gains because we didn't want to create a large tax event for people. So what we have been doing, as Laura's going to describe in a minute, we've been trying to actively manage those accounts to try to capture losses to offset the gains in those positions to enable us to make improvements in your portfolio, quite honestly.
Right. So if you had bought a asset or an investment for $100 and it went up, actually this slide got all messed up apparently, but assume that it went up to maybe $120, you actually would have a $20 gain that you have to recognize with the IRS, and you have to take a taxable hit for that. And that's what concerns a lot of folks. So what we're doing right now on the next slide, it shows how we're looking at those gains and we're saying, now's an opportunity where there are some investments that have actually declined. Let's harvest those losses. So in this case, we have $100 stock maybe that we purchased, and now it's actually declined by to $80. And so we have that $20 loss. If you marry that $20 loss with that $20 gain, there is no gain.
That's right. And by the way, our normal process is on holdings that we've chosen and we want to keep is to try to defer gains as long as possible. That's our normal approach there. But if we think it makes sense, we may offset some of the gains with losses on other positions. So there's no gain in this case. You basically wiped it out. You offset the gain with the loss. So in effect, you've it's a wash from a tax standpoint.
So some of you might be saying, yes, but you have this whole concept of strategic investing and asset allocation. And what if we have a situation where investment C, you can see, actually went down in value, and you're saying that you're going to sell it, but don't you think that it has a strategic position in your portfolio? And you would be absolutely right. We do believe that we would want to hold an investment C or investment C look-alike type of investment. So there's a strategy with that, which essentially on the next page talks about, here's investment C. It's a clear glass, and we want to recognize this loss. So we're going to sell investment C, and we're going to replace it with an asset that is very, very similar. It's still a glass, but it's now tinted with the red coloring. And so there are opportunities to do that, but you have to be very careful when you do that.
You do. And also in our case, we're really careful to make sure that the similar investment is something that we would also have considered using in our client portfolio. So we don't want to sell some fund you own or ETF that at a loss and put you in something else that's not quite as good of an investment. So we've done a lot of research to try to find equivalent investments that we would hold otherwise. Because we may choose a certain investment, but there may be 5 other great choices. And we just chose the one we have for various reasons. But in a different time, we might have chosen one of the other 5, but they're fine too. What we don't want to do, especially with a volatile investment like the large cap stocks or even small cap stocks, is to sell that investment to capture the loss and keep you out of the market until something which we're going to discuss soon, called the 30-day wash rule, expires. We can't keep you out of the market even for 30 days when we're experiencing the types of volatility we're seeing right now. For example, in July, the S&P was up 9%. Now it's down 4 or 5%, I think, or was down 4 or 5% for August, but in July it was up 9%. And so if we had avoided putting you back in the market in a similar investment for 30 days, well, that would have cost you 9%. And it probably would have wiped out any benefit you would have received by capturing a loss. So we can't do that.
And so, in this case, there, if you have some losses, and if you have some gains, this loss becomes very, very valuable. But don't be fooled. It still is very valuable. It still is an asset, because no matter what, if you have no losses, you can recognize up to $3,000 on your current income tax return for the current year. But you can also hold those losses until you are able to use them in the future. So they actually become an asset on your balance sheet.
Yeah, they can be carried forward forever. Now, I want to mention about this 3,000. What's particularly sad about that number has not been increased, I believe, since the 1980s, I think. And so with inflation, it probably should be 10,000 or 9,000. And, I'm hoping someday Congress comes to the realization that it's really not fair to tax gains fully and not to provide some offset when you have to capture losses, even if you don't have gains to offset it with, that it really should come off your ordinary income too. To some a greater extent than they allow. And so this is what I was talking about earlier. This is an IRS rule. So why do they have this rule? Well, they have this rule because if they didn't, people would sell something at a loss and the next day buy it back, with that lowered cost basis. And they could keep doing that and constantly capture losses. But what they don't allow you to buy the exact same investment either 30 days prior or 30 days after you've sold it to capture a loss. And as this is called the 30-day wash rule. I don't know how long it's been in effect, but I'm going to say probably since the 1970s.
It's been around a long time, and they're really trying to deter day trading. They don't want you to actively trade back and forth. It's usually very damaging to people's portfolios. So this is one of those rules.
Yep. So, and we mentioned about this capital loss, that if you don't use it in the same year that you've captured it, it can be carried forward forever. And I think the second point here is really important. It doesn't save tax. When you capture a loss and all you're doing really is deferring tax on an asset, because the disadvantage here though is you've lowered your cost basis in an investment category you probably want to hold for the long term. So your original cost basis was $100. It went down to 80. You sold it. Now, when you reinvest that $80, the cost basis on the new investment is $80. So in effect, if you waited now and that new investment recovered back to 100 and you sold it, basically you have a wash. Now you have to show a $20 gain, and that's going to offset that $20 loss you might have captured last year. So really what losses really do is they defer taxation. And the advantage we're going to cover this a little bit later. The advantage here is the earnings you can, what you can earn on the taxes you haven't paid. So really that benefit doesn't really accrue until you've actually offset something else with that loss. And that's when the benefit begins to accrue, because now for example, on a $10,000 if you say 10,000 in tax and it's a 15% capital gains rate, you're in effect saving $1,500 a year. All right. And it's the earnings on that 1,500. That's really the benefit here. I know I'm making it sound a little complicated and confusing, but that's the reality here. We have a slide that'll talk about
Yeah,
that.
it's on the next page.
Yes. Thank
So
you.
we're assuming that loss of $20. And it, in theory, you're saving $3 in tax, a taxable gain, which is 15%.
Yep.
Most of our clients are 15%. There's a couple of folks that are at the 20% bracket.
Yeah.
But the question is, what do you
actually it's 23.8, by the way, if you hit certain levels.
Right. But if you can invest it at 8%, that's really the advantage that you're going to achieve.
Yep.
Is that opportunity, and as it grows, you can continue to. The whole idea of compounding comes into play, and it goes on indefinitely until you actually decide to sell at a gain, or the stock settles back at its current price.
So I want to mention something. You have to be careful with this capturing losses, because you don't want to capture loss on something necessarily and then end up in a higher tax bracket down the line. Because as we mentioned, you've lowered your cost basis now on that asset, or that asset category, I really should say, that you want to hold. Now, if you're in a 15% bracket and now you're going to be capturing a gain somewhere down the line 5 years from now, you're going to recapture that gain at some point, and you're in a 23.8% bracket, you really haven't helped yourself very much. So you have to be careful about what bracket you might be in the future. So it makes it a little complicated.
Right. And that's discussed a little bit on the next slide, where we have a whole list of disadvantages. And we could talk about these. I don't know if they're all disadvantages. They're just concerns or things to watch out for. They're things that we want to look at. And for those clients that we have really been able to benefit by using these kinds of strategies, we've been very careful to understand what their current taxes are today and what their future taxes are going to be.
Yes.
So that is part of the reason why comprehensive planning becomes so important.
Yep. Yeah, and I think we've probably mentioned a lot of these already, right? These disadvantages, I think, in the conversation. Is there anything you want to highlight in particular here? I think the bottom one's important. If you're in a low tax bracket, it doesn't necessarily make sense to capture losses, for example.
Absolutely. That's important.
And obviously, it's very obvious actually, that you don't want to capture losses on a tax deferred account. It doesn't really make any sense, an IRA or a Roth, for example.
Yeah, I do think we covered most of that. And then in terms of the overall strategies, even we're discussing a lot of that, because there are some people that it really makes sense to not even to go the opposite way, to not even capture losses, but let's recognize some gains, because you don't have a taxable event occurring. You're in a low enough tax bracket. For single people currently in 2022, it's anything below $41,675. And for married filing jointly, anything under a taxable income under 83,350, you have no taxable events. So let's recognize the gains today.
That's correct. And you're not going to pay any tax on it, but you do want to be cautious. I've tested this in our tax software, and it's not always very obvious, but what happens if you're receiving Social Security, you could end up pushing yourself right out of that bracket, that 0% capital gains bracket, because now suddenly that gain is counted, even though it may not be taxed directly, it's counted toward your how much of your Social Security becomes taxable. So you have to be a little cautious there. And I've tested this number, and it depends on a lot of other factors. It's not a simple equation necessarily. If you're considering this, let us test it in our tax software if you're receiving Social Security. In particular, if you're receiving Social Security.
And then we have a whole nother group of strategies just talking about, so Steve and I have been talking a lot. Even yesterday, we for one of our clients who had significant gains, and we were matching up all the gains with the losses, and then what are we going to use to replace some of the things that we're selling that had losses, but we still want exposure to. And there was a whole analysis that we went through to do that, and we've been doing that on an ongoing basis.
Yes. Yep, we have been. Yep, on a continuing basis.
And making sure that we still buy something else that gives us exposure to that particular investment, really important.
Yeah. And so this is a complex topic. And you see, even we struggle at times trying to explain it verbally, some of the aspects of this, because it is complex. And it's hard to explain verbally at times, because it's just complex. What else can you say about it, But it does make sense, and I'll say that cautiously, to capture losses, and also to cautiously capture gains if you're in a 0% capital gains bracket, as we mentioned, but with caveats in both cases.
Yes, and I guess one last thing that I maybe want to broach that we didn't even talk about, Steve, but since we are talking about taxes, I'm thinking that we should, is that even if this 2022, our hope is that it winds up being an up year. It's not over yet. You don't know. But if it does turn out to be a down year, and we have those periodically throughout the duration of investing, there is a potential for some people that have taxable accounts that they will be recognizing dividends and gains. And that can sometimes be a little bit frustrating, because you feel like, okay, investments are down, but when these different investments pay out dividends, it still is a taxable event.
It is.
We're trying to do our best to help mitigate that, because we know that just doesn't feel good. But I do want to bring that up, because we do have some folks that have very large taxable accounts as opposed to just qualified accounts where it's all sheltered.
And there's one asset class in particular that we're concerned about. That's the natural resources, and it's up around. I checked again. I think yesterday it was up about 30% again for the year. It had bounced. It's been bouncing up and down. At one point, it was only up about 20%, but it's back up to about 30. And last year, our natural resources, even though it was an ETF and they're typically pretty tax efficient, it paid out about 25% of its net asset value as ordinary income, because it had so much in gains, and they had to pass that through, unfortunately. And we expect that could happen again this year. Now, where possible, as Laura mentioned, if we can try to put that asset class in your tax deferred account, we've done that. We try to do it as much as possible. But if you mostly have a taxable account with us, our hands are kind of tied in that area. What we might be able to do is we may be able to, depending, sell it before they make the distribution and capture it as a capital gain rather than a ordinary income. So that's something we may consider looking at later.
But either way, you're going to either get a capital gain or you're going to get a dividend,
Ordinary
because
income.
That is an asset class that has been one of our saving graces this year. Actually,
Yes.
It's helped. It's one of the ones that have done really well.
What about 4 that have held up pretty well this year?
Right. So if you have a question regarding your particular account or your portfolio and you want to discuss, especially over the course of the next several months, we're going to continue to be looking at any opportunity where we can add to your taxes and help improve that situation. So please let us know, and we'll be happy to talk about it. Thank you for joining us today, and we'll see you again.